How's it going, everyone? It's Sam. Today we're talking about VTSAX, and this is one of the best investments that you can make. I'm going to go over what it is, how I implement it into my investing, and some of the pros and cons of it. So you guys should definitely watch through to the end because this is all really important if you're looking at investing. I mean, a lot of people won't spend 10 minutes watching something that will benefit them for the rest of their lives. They just don't even want to spend 10 minutes, but this is your money. So you should definitely do all the research you can to make sure you're spending it the right way. So definitely stay through to the end. Also, hit the like button if you don't mind. It really helps out the channel. And let's get into it. So VTSAX is through Vanguard. They really pioneered what is known as index funds. So index funds are a collection of different companies in the index. So instead of just putting your money into, let's say, Facebook stock, instead of just putting it into one stock, it has a distribution of, let's say, 500 or 1,000 or 10,000 different companies. So there are a lot of benefits to this. Now, how I use it is I have a significant amount of my wealth in these index funds. So VTSAX is the Vanguard Total Stock Market Index Fund. I have something called VOO, which is pretty similar, honestly. It might be like 98 or 99% the same thing. It has the largest 500 companies. And you can see here a significant portion of this account is in VOO. I also have very similar funds in all my other retirement accounts, but they are a great thing to invest in. And you can see here, I've actually done a video on it before because some people claim you can get more than something like VTSAX with other mutual funds I've talked about with Dave Ramsey. And I'll link to this at the end of the video too if you want. But Dave Ramsey claims you can get 12% with different mutual funds, but VTSAX is one of the best ways to invest. So with mutual funds, and I explained this in that video, mutual funds often charge a high expense ratio. They might charge you 1 to 2% depending on what the fund is just to invest in it. So over time, that 1 to 2% takes away massively from how much money you have. And you don't really realize it at first, but it can be a massive amount of money you lose compared to something like VTSAX. And a lot of people try to go after the hot new mutual fund or whatever mutual fund did well last year, but a lot of the time, they don't do well this year if they did well last year. So it's really hard to outperform VTSAX because it collects from all the smaller companies that shoot up in price and it averages those out. So it's a very safe way of investing. And we'll go over kind of what you can expect from it here. So with the Vanguard Total Stock Market Index Fund, you don't get a flat 7 to 10% each year. As you can see here, the returns can be anywhere from -4% to 22%, and it goes back and forth. So any specific year, it can be down or it can be up. It's just a collection of the different stocks in the stock market. We'll go over which ones are included and how much, but it can go up a pretty significant amount or down a little bit each year. The average, though, is about 7 to 10% return. So this is a pretty consistent way of investing, especially if you're looking over the next 20 or 30 years. And it's a really good way of investing for the long term. So again, I'll go over some of the pros and cons at the end. We're just getting a little bit more research on VTSAX and beforehand. So if you go to Vanguard's website, this is actually the first place I ever invested $1. And I actually invested it in a very similar fund to VTSAX. The problem with Vanguard that I see is the fact that if you use their investment website, you have to invest $3,000 minimum. I didn't really like that. I mean, I did it. I didn't really realize there were alternatives like Robinhood, like WeBull, like M1 Finance. And with this, you have to invest $3,000. However, with M1 Finance and WeBull, you can invest in these types of companies without having to put up $3,000, which is huge, right? So as a new investor, you might not have $3,000. You might not want to wait until you have $3,000 to start investing. So if you want to start investing, I do have links down there below. You can start with WeBull, and if you deposit $100, you get a free stock worth up to $1,600 at the time of this recording. Or you can use M1 Finance. They are where I hold the majority of my money. You can see it here. I have about $17,000 between my different accounts at M1 Finance. I really like them too, but you can invest a lot less and be able to invest in these index funds compared to Vanguard. Now, with this fund, you can kind of see how it's broken down. You can see the average return over the last 10 years. It's about 13.5%, almost 14%. You can see about what you'd have if you had invested 10 years ago in VTSAX. If you started with $10,000, you'd have about $40,000 now. So it's gone up by a factor of 4 in 10 years. Let's say you invest $10,000, it goes up to 40, then it goes up to 160, then it goes up to 640. That's 30 years down the line. And that's just from your initial amount, right? So hopefully you're investing along the way and not just investing one lump sum up front. Hopefully you keep on investing. So as we go down, you can see kind of how it's broken down. You can see the portfolio equity sectors. It's very heavily weighted towards financials and technology. You can also see healthcare and consumer services are a pretty big part of it too. It's not really geared towards telecommunications like AT&T or Verizon. You can kind of see that there. The major companies are ones that you've probably heard of: Apple, Microsoft, Amazon, Alphabet, which is the parent company to Google, Facebook, Berkshire Hathaway, Warren Buffett's company, Johnson & Johnson, Tesla, Visa, Procter & Gamble. So it's obviously got some of the biggest companies in the world, and then it's also got a significant amount of other companies too, but this accounts for about 25%. You can see that they're really broken down across many sectors, and there's a lot of money spread out. So this has about $1 trillion in it, the total fund assets. And this is something that a lot of people like to invest in. It's very steady. It's a lot less risky than individual stock investing. So I only got into individual stock investing this year because there's a pandemic and some stocks were going down so quickly, and I didn't feel like they should go down that quickly. I felt like the value was still there. So I want to invest in those individual stocks, but I still hold about 50% of my net worth in these index funds. So a lot of people, when they're starting to invest and when they're really thinking about investing, their main goal is to hit $1 million. So they want to know, how do I hit that? And if you Google it, you get all different kinds of information, from starting a business to drop shipping. It's really interesting to see all the different ways that people say to make $1 million. A lot of people have these scammy drop shipping sites too, from 0 to $1 million in 8 months. And who knows, they could be right. But with VTSAX, with your 7 to 10% annual return, if we say it's an 8% return over 36 years, so maybe you're 24, 25, and you want to retire at 60 or so, if you deposit $100 into something that pays this amount, you'll have $1 million. This is significantly more than what people usually retire with, right? So I'm doing this actually in my M1 finance portfolio. I have more investments than just this portfolio, but I'm depositing $100 a week into this portfolio specifically to get to that $1 million. Dividends are cash payouts from companies, and it's pretty easy to predict how much money you'll make from dividends over time. So these companies raise them year after year. They don't really like to cut them very often. Some do, obviously, when we have things like the pandemic, but I've been tracking and trying to grow this portfolio, and I've done a pretty good job so far, about 12% in just the first 3 months or 2.5 months. But I have a mix of this and index funds and growth stocks. So I'm pretty well diversified, even over different investment strategies. But I want to hit on some of the pros of this too. If you haven't already looked into VTSAX or index funds, one of the pros of an index fund is that you're well diversified. So if I have $2,500 in Facebook stock, which I do, and if they go down significantly, and that's all of my portfolio, which it's not, but if it goes down significantly, let's say 50%, Mark Zuckerberg comes out with something really awful. He says something that is very not politically correct or something, and let's say they have bad earnings or something like that. Let's say they go down 50% over the next year. That's a big hit to my portfolio. That is really significant compared to if I am invested over 100 different companies, then I am a lot safer in my investment. I would assume that it's not going to go down 50%, but if it does, it's still safer than investing in individual stocks that maybe go down even more than that. If you pick the wrong stock, it could go down and get to zero eventually. So you've got to be careful when you're investing in individual stocks. So that's why a lot of people like index funds, because they are well diversified. You can also get some of the growth from stocks that you've never heard of even. The next thing is it's very easy to invest in these index funds. So what do I mean by this? You don't have to be an expert. You don't have to do research. You can just know that you should put money in VTSAX and put it in there week after week until you're retired, and you will probably be fine. So it takes very little effort. It's very easy to invest in these. Another great thing about VTSAX or other index funds is there's very little psychology and very little emotion. So a lot of the time when we invest in individual stocks, our mind kind of does the opposite of what's smart. So when a stock goes up significantly, it might not always be the best time to invest because it is now more expensive than it was before to get the same earnings. But what our brain tells us to do is we see the stock go up and we want to get in on it. So a lot of the time we'll put money in when it's almost at an all-time high or when it is at an all-time high. And a lot of the time that's not always the best time to invest. Now, I'm not saying that's all the time, but a lot of the time too, when it drops, when it's possibly the worst time to sell it, right? So it drops significantly, but maybe it's dropping for the wrong reasons. Our mind tells us that we should get out of the stock. We should sell off the stock. So there's a lot of emotions that come with investing in individual stocks, especially if you're not well diversified. So I hold maybe about 20 different stocks in my portfolio that are individual stocks. So when a stock goes down, I don't really get uncomfortable with it because I'm not losing 10% of my portfolio or 20% or 30%. So I'm okay with that. I'm okay with the emotions. I can handle it. That's how I've got my account set up on purpose. I've tried to plan that out. But with index funds, there's very little emotion. Like I said, yeah, it can go down 1 to 5% maybe a day, but that typically doesn't happen very often where it goes down more than 1% or 2%. Obviously, during the pandemic, we had massive changes in price, and that was a crazy time for everyone. But generally, there's very little emotion with these index funds. Now, it's also very cheap. So compared to something like mutual funds, like I talked about with that Dave Ramsey video, mutual funds can cost 1 to 2% to invest in. Over the length of your investing career, that could cause you hundreds of thousands of dollars in fees. Index funds are very cheap. This VTSAX is about 0.04% expense ratio. So if you have $1,000 invested, it would only cost you 40 cents a year to invest in it. Now, that is very cheap and a pretty nice way of diversifying, and they really aren't taking much for the money that you're putting in. So they're doing the work, but they're not really charging that much. It's a very cheap way of investing, especially compared to even like a financial advisor who might charge you anywhere from 0.1% to 1 or 2%. So those can really kill your returns over time, especially if they're investing in mutual funds and then you're also paying for them to invest in mutual funds. That's a killer. Some of the cons, though, are you can't get as much potential growth. So I have a couple stocks like Tesla, like Workhorse, that have returned really well over time. So Tesla, I'm up about 200% on. With Workhorse, I'm up about 30% in just a few weeks. Now, with these kinds of stocks, you can get this massive growth, but when you invest in index funds, you're probably not going to see much more than maybe 20% over a year, and that's a very good year. You'll probably, like I said, see about 7 to 10% on average. So you're not going to get as much potential growth, but there is less potential downside too. Now, they can also be overinflated, just like stocks. This is the other point too, where just like a stock can be inflated, maybe Facebook is, twice the price that it was last year. Well, these index funds can jump up significantly in price too. They can sell for a very expensive ratio compared to the past, just like stocks. However, they generally don't get to that point that some stocks get when there's a lot of hype around a stock. But there can be kind of these bubbles, especially because a lot of retirement accounts just throw money into these index funds. They just throw money month after month, week after week into these index funds, and this can cause the price to go up because people aren't really investing because they believe in it, just because it's an easy way of investing, and this is their retirement plan, just to throw money at it no matter what the price is of the index fund. And this can kind of make the price get more inflated, especially compared to maybe 10, 20 years ago when index funds weren't as popular. So thank you guys for watching. Let me know your thoughts on VTSAX below. If you're new to the channel, please hit the like button and hit subscribe too. I'd love to have you join us on this channel. We talk about everything from investing to personal businesses to individual stocks to news to stimulus, everything that you might think of for finance. We talk about it, do daily videos, sometimes 2 videos a day. I would really appreciate you guys joining the family. Also, down there in the description, if you want to start investing and you don't want to put $3,000 into Vanguard, you can check out M1 Finance as my favorite broker, or you can get free stock with WeBull. Thank you guys so much. I appreciate it, and I will see you in the next video. Bye.